bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the April 21st, 2026 episode. As our audience on YouTube can see, my guest this week is my partner, Tony Grappone. And our regular audience knows what this means, with Tony being a leader in Novogradarac's Renewable Energy Tax Credit Group, which of course means that this is the latest episode in our Renewable Energy Tax Credits Finance series. Now today's topic, could it be any more time? We're heading into a pivotal moment for renewable energy developers, especially given the July 4th start of construction deadline. That deadline is quickly approaching for wind and solar projects. At the same time, the renewable energy market is experiencing a surge of both new developers and a wider range of technologies. And many of these new developers are now navigating tax equity, transferability, and investor expectations for the very first time. With so much changing and so much at stake, execution has never mattered more. And that's why today we're going to share key topics every renewable energy developer needs to know in order to attract investors. Now, this is a two-part episode with the second part airing in May. The two-part episode is to cover 10 major topics. We're going to discuss the first 5 today, the next 5 in the next episode in May. And just to keep you wondering, we're not actually going to tell you what those 5 major topics are for the next episode, but we will tell you the 5 for this episode. The first one, which won't come as much as a surprise, are the rules around the beginning of construction requirement that'll have to be satisfied by fastly approaching July 4th deadline. Now, the second area we're going to cover are common errors and oversights that we find in developer financial models, particularly new renewable energy developers. The third topic is the expectations gap. Once again, the expectations gap between newer developers and the reality of the investor market. The fourth topic will be somewhat brief, but we're going to talk about the timing of investor capital contributions and how they're not quite as rapid as developers would generally like. And we're going to close out with the topic that we're seeing a bit more of, and that's co-mingled investment opportunities. A co-mingled investment opportunity, for example, would be an opportunity where a developer is developing both a data center along with renewable energy assets to help provide the energy for that data center. Now, I'm always very happy to welcome Tony back as a guest. He was and has been helping both developers and investors adapt to the post One Big Beautiful Bill Act, or OBBBA landscape. He does bring a unique perspective on what it really takes to get transactions across the finish line in today's financing environment. And he's taken the lead on many additional services that we're now providing that are motivated and needed based upon the tax legislation and the changes to the tax code provided in the OBBBA. Obviously, as you can tell, we have a lot to cover today. So if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday. You're counting, I am sure. This is your 35th appearance on Tax Credit Tuesday. You have many of your fellow partners and colleagues that never get jealous of a 35 number of appearances. That said, for our regular audience, you obviously don't need an introduction, but we do get a lot of first-time listeners. So for those who don't know you yet, please provide a short intro of the services you provide to Novogradac clients.
Sure. Great. Thanks, Mike. Glad to be back as always. So 35th appearance. Do you think I have a comfortable lead at this point?
You do have a comfortable lead, but I will say we started a Washington Walk. Peter Lawrence will be coming back, so he might be trying to catch you.
Okay. All right. So I won't rest on my laurels here. Okay. All right. All right, but great to be back. I love the podcast and appreciate the opportunity. As far as the services that I provide here at the firm, most folks know I offer three silos of services, one devoted to financial statement audit services, another devoted to tax return preparation services, and a third geared towards what we call transaction advisory related services. And that's what we're talking about here today. So under that transaction advisory umbrella, we're talking about financial modeling services, maybe cost segregation services, even agreed upon procedure consulting style engagements can fall under that transaction advisory related umbrella. And today, I think we're going to focus mainly on financial modeling as well as cost segregations.
Great. Thank you for that. And I should have mentioned earlier, I do look forward to seeing you in San Diego in just about a month, May 14th and 15th at our Spring Renewable Energy Tax Credits Conference. I will suggest to listeners to consider registering and joining us at that conference. And if you do attend, please take a moment to come up and say hello to Tony and to me. We always enjoy meeting our listeners and viewers at our conferences and at places. So let's start with the first topic, and that is to do with the start of construction rules as we approach the July 4th deadline. If you could maybe take a second to explain the July 4th deadline for those that are newer to the renewable energy space, and what are some of the critical aspects of ensuring that you satisfy the requirement to begin construction by July 4th?
Yeah, great. Thank you. So this is really a big reminder for wind and solar developers. Okay. If you're a wind and solar developer and you don't start construction on your facility until after July 4th, 2026, then you will need to have your wind and solar project placed in service no later than December 31st, 2027. Okay. So that's obviously a compressed timeline. If you start construction on your wind and solar project on or before July 4th, then you've got a longer runway to get your facility placed in service. Okay. Assuming you maintain continuous construction efforts, et cetera. But if you start construction on or before July 4th, you'd have until, say, for a calendar year taxpayer, you'd have until the end of December 31st, 2030 to get your facility placed in service. So obviously, starting construction on or before July 4th provides a lot more comfort and timing to get your project fully constructed and online. We're talking about wind and solar here. And that was a rule that came out as part of the big, beautiful bill that was passed last year on July 4th of 2025. And so a lot of people are aware of this, but there's been so many changes with cliff dates and start dates of beginning construction. It's really difficult just to keep track of the various start of construction milestone dates, how you comply with FEOC, when your facility can be placed in service and so forth, when you need to comply with PWA, et cetera, et cetera. So just remembering when these important dates take effect, I think is super important, obviously, and just want to make sure wind and solar developers have this on their radar.
We did throw out a couple acronyms. So I will ask you to define for those newer to our audience what PWA is and what FEOC is.
Great.
Very briefly.
Great. That's a little bit of a tease as to some topics that are going to come up in the May episode. But
Okay.
PWA stands for prevailing wage and apprenticeship criteria, and FEOC stands for foreign entity of concern.
Great. And foreign entities of concern, can't provide too much assistance or ownership of a given renewable energy facility.
That's right.
As a general rule, or as a general overview. And we'll go into that more in the next episode.
Yep. And we do have some podcasts that we went into more detail, both on FEOC and with PWA. I did a podcast with my partner, Josh Morris, which was a pretty solid deep dive on the FEOC rules. We did that a couple months ago. Mike, I know you and I have done podcasts on PWA before. And so if you want more of a deeper dive on those topics, feel free to refer back to those other podcasts. And then next month, we will do a refresh on hottest topics and issues involving those two criteria.
And we will link to those prior shows in today's podcast. Before we leave this topic, how are investors getting comfortable with a particular development that it has met the July 4th deadline? Because if I'm a developer here, I'm thinking at the end of the day, It doesn't matter that I think I met the deadline. What matters is that the investor is going to put in millions, tens of millions, hundreds of millions of dollars into the investment, that they are comfortable that I met the deadline.
Yeah, great question. And I love the way you asked it. So a couple things here. Number one, I didn't mention this previously, but if you're a wind and solar project, you're starting construction on before July 4th, you have to use the physical work test, unless you're a solar project that's under 1.5 megawatts. So that's another reminder. If you're a developer and you think you can use the old 5% test, you can only use that 5% test if you're a solar developer working on a solar project that's under 1.5 megawatts. If you don't check that box, then you can only use the physical work test here. Now, more to your point, Mike, if this is cliff test, you need to meet it clearly. Okay.
Right.
You want to exercise a lot of caution here. And so what are developers doing? I'll talk in the context of solar for a moment. A lot of solar developers, when they like to start physical work of a significant nature, they like to try to do that off-site. And how do you do that off-site? You start work on some type of major component, but that component has to be a unique type of component tailored for this very specific project. It cannot be a component that's normally held in inventory. The most common type of component used for this context involves transformers. Transformers were mentioned in a piece of IRS guidance, and as a result, the investor community has gotten very comfortable with transformers. But what I will just caution you against is if you're thinking, oh, I'm going to try and do some kind of module or racking, you do not want to pursue some type of component that could be construed as normally held in inventory.
Well, thank you for that. We can move on because that could obviously, that is a whole separate podcast and the rest, but I just wanted to have you share a few words about that because developers want to make sure that before July 4th, that they're working with tax professionals that give them counsel on what approach they're using and its level of acceptability within the investor market. Because at the end of the day, like I say, if the developer thinks they met it, but the investors aren't comfortable, then it doesn't really matter.
Exactly.
Investors have to be comfortable.
Yeah, please reach out to us, whether you're on-site or off-site. We're familiar with which activities qualify, which activities do not. So feel free to call us. The biggest mistake a developer make here, by the way, is also delaying. This date is fast approaching.
Right.
Developers should have started this probably yesterday or sooner. But reach out to us. We can help make sure you understand which activities qualify and which don't.
Before we move on, anything else you want to say about the start of construction requirement?
Just that, to your point, investors really are going to underwrite this issue carefully.
Yep.
I'll tell you, I've been out in the industry this year, talking to developers, talking to investors. There are developers that did start construction on a lot of pipeline prior to 2026 to avoid some of the FIAC requirements. They're really glad they did that. It's going to be the same type of thing here. After July 4th, the developers that were able to start construction before July 4th, those credits are likely to be worth more than credits that started construction after July 4th. So it is really important.
Got it. And you don't want to be saying I started it on July 3rd or
Don't delay.
No delay. Okay, let's turn to the second of our 5 topics on this podcast, and that has to do with financial models. And when we were preparing for the podcast, you expressed how there were a number of areas where newer developers can make some pretty notable errors or omissions in financial forecasts. If you could just describe some of the broad categories and maybe an example within the sort of broad categories where you see common errors
So,
or oversights.
Great. So I'll talk about the operations side of the model, then I'll quickly dovetail to the construction side of it. In terms of operations, lesser experienced developers, they tend to model out things on an annual basis. Investors expect to see that information model on a monthly basis. And I'm talking about EBITDA. So you want to get your sales, your energy production, and all your core operating expenses modeled on a monthly basis. A lot of first-time models we get are done annually, so those need to be broken out into more detail. Other things with accounts receivable, a lot of developers assume that cash is going to come in on revenues sooner than what's more likely to happen in reality. So you want to factor in some sort of timing delay there in terms of when you earn the revenue versus when you collect the cash. Same thing on the expense side. We see some developers They don't really understand the difference between when they incur an expense versus when they pay it. For example, insurance premiums, oftentimes those have to be paid fully up front, okay, and say January, but then the expense happens ratably over the year. And so some developers just assume that expense gets paid monthly. Well, no, it doesn't. It gets paid all up front and it gets expensed monthly. Developers sometimes will do things like expense cash reserve fundings. So they'll take a deduction for cash reserve funding when that's not allowed for tax purposes. They might forget to apply the ITC basis reduction to depreciable basis, so their depreciation deductions will be overstated. They might forget to capitalize major repairs and maintenance that happens to the facility over time. These are just a few. Other things, a lot of developers have a tendency to understate property tax amounts and general administrative expenses. But reach out to us. We work on a lot of models, so we have a lot of experience to draw from and can give you some comments in terms of our thoughts, in terms of your accuracy and completeness of your assumptions.
Now, one of the other oversights it seems like is more common are local business taxes. Want to say anything about the local business taxes and how, particularly if you're a developer working in multiple locations, not even being aware of certain local business taxes?
Right. And we have a practice here at the group. We have a practice here at the firm that specializes in state and local tax matters, and they can be really helpful on this front as well. And then on the construction side of things, we see situations where developers just assume 100% of their construction costs are going to be eligible for the investment tax credit. Obviously, that's almost never the case. There are some classic costs that need to come out of eligible basis. I'll name just a few that we see: security, fencing, prepaid O&M, extended warranties. These are examples of costs that developers oftentimes inadvertently include in an eligible basis. Another significant mistake we see with developers when they're calculating eligible basis, they don't necessarily understand how to allocate indirect costs to eligible basis. So indirect costs are things like carrying costs like insurance, taxes, overhead, payroll, that sort of thing. And then balance the system or profit and overhead on the EPC contract. These are all examples of indirect costs that need to get allocated between your eligible and your ineligible costs. And so a lot of times developers will just inadvertently take all their indirect costs and assume they're eligible for the ITC when really there's a portion that ultimately ends up being allocated to ineligible costs as well. But we can help you analyze that and make sure that you're better budgeting what your tax credit dollar amount is going to be.
When you share what you shared, it just seems like initially revenues get to be a little higher from a cash flow perspective than when they'd be realized in a timing perspective, and maybe overall, and maybe operating expenses end up being understated or things get missed. And then maybe tax credits can be overstated. Those are all kind of general matters, but I'm sure you've had this as well. I've also seen the opposite where indirect costs aren't being properly capitalized to the tax credit basis and the like, such that it actually ends up being more credits available. But at the end of the day, of course, it's all about getting something that is supportable such that investors will come in and see the forecast and have comfort with the forecast based upon the investor's experience. I presume it's pretty important that developers do this before they start talking to investors.
Highly recommended. That's right. So that's another thing we do because we work on so many transactions. We're in tune with the latest trends in the marketplace. And so as we're helping a developer improve their financial model, we can also help it get it prepared and presented in a way that is in line with how investors normally like to review information, which can also help those initial conversations with developers go better. You know, the old saying, you only get one time to make a first impression.
Yeah, that's what I was going to say as well. You definitely don't want to go in with something that makes you come across as more inexperienced, because clearly investors are generally about scale and experience. And from an oversight perspective, they don't want to go in knowing that this particular project is going to take a lot more oversight because of these experience gaps. So I appreciate you expressing all of that. There is also one of the many services that you've helped roll out has to do with cost segregation studies. So tell me, well, you probably don't need to tell me, tell the audience the purpose of the cost segregation studies and why they're so helpful.
Yeah, exactly. So Because developer, that's where we analyze all the different construction cost line items, and then we put them into their buckets of what's eligible, what's ineligible, what's an excluded cost, what's an indirect cost. And then that helps figure out what ITC eligible basis is. From there, we take that a step further, go through similar exercise to figure out of those total costs, how much are depreciable over, say, 5 years versus 15, 20, and so on, which are depreciable, which are amortizable. And so it's a very helpful number crunching exercise to help you fine tune what your eligible basis is going to be. And in the marketplace, that's one of the deliverables that pretty much every investor requires as a condition precedent to either investing or purchasing tax credits. And so if it's not on your radar, you definitely want to think about reaching out to us to see how we can help you. We do those in 2 stages. One is a preliminary, and so that's on the front end. And when we do the preliminary, we're looking at your budgeted construction costs. And then we do a final, which is after the facility is placed in service, we come back, look at underlying cost report, et cetera, to help do a final verification of actual costs.
Great. Let's move on to our third topic. And that has to do with what I sometimes think of as an expectations gap. And that's a expectations gap between a renewable energy developer newer to the area and what the market for an investor is. So with that, if you could explain some of the areas where when you're working with a new renewable energy developer, what sorts of expectations they might have versus what the tax credit investor market and cash flow market expects.
Yep, great. Since the tech neutral credits came into effect and the big beautiful bill was passed, that has made things a little bit more challenging for wind and solar. We've definitely seen newer developers into the marketplace that don't have experience with tax equity. And so they're not familiar with what types of structures investors prefer or sometimes require to invest in one of these transactions. The structures that investors prefer or sometimes require are structures like the partnership flip structure, or sometimes called the pref equity structure, or maybe an inverted lease structure or sale leaseback structure. So those 4 are the most common structures used in the marketplace. And so developers need to know what those are, because that's what you're going to really, at the end of the day, need to use. It's not like you just bring any old kind of partnership arrangement to an investor and say, hey, I've come up with this really unique partnership arrangement. How would you like to do my deal? That's not really how it works. But what we see is these newer developers, they just don't have the experience to know how that's how it works. And so we'll get pitched an idea from a developer. They'll say, look, I've got this partnership. I think I can get maybe this household family name bank in my deal. They're going to be a 50-50 partner with me. And we're going to share credits, losses, and cash flow in this really interesting way. And so there's an education process there where we bring them up to speed. That's not really how investors like to look at these types of deals. They've got a certain playbook that they like to stick to. Here's what that playbook looks like, and we can help you work within those playbooks.
Great. Thank you for that. And there's so much more we could say about the different structures. And we do have prior podcasts on that. So we'll link to some of those as well, where we went through some of the different structures. And you see the pause in my voice because I grew up as a tax accountant, as the audience knows, and I can get pretty wonky on tax topics pretty fast. When we are thinking about these partnership structures, we do have the partnership concepts like cap account maintenance, DROs, minimum gain, 731 and 734 adjustments.
Right.
So there's a lot of those sorts of tax concepts that developers generally aren't all that aware of. And obviously they don't need to be aware of. That's why they hire tax accountants. But what do you want to say about all the tax structuring and these other sorts of rules? What advice do you have for renewable energy developers, knowing that these sorts of rules are there and are very important as part of the structuring?
Yeah, so those tax issues or rules that you just alluded to, min gain DROs, 731 gains, 734 step ups, right? Those are unique partnership tax issues. They come into play when you have partnerships. Now, when we work with the newer developers, sometimes they're intimidated by this space because they think, oh my goodness, do I have to know every tax rule? The Internal Revenue Code is huge. Do I have to know every single tax rule? No, you don't. I mean, obviously, the more you know, the better, but you don't need to be an expert on tax rules. Again, that's why you work with firms like us. But what you will find out is that there are some that you obviously want to be aware of and somewhat conversant about. And really, we're talking about there's a finite number of partnership tax issues that at the end of the day, if you work in the space, you'll want to at least have some decent familiarity with. I guess the good news is it's not this like exhaustive list of tax issues. It's a fairly finite list, but they tend to be important. And those issues generally are with respect to partnership tax rules around how partners in partnerships can use tax benefits. And I'll give a little plug to the San Diego conference. At our San Diego Renewable Energy Conference on Wednesday, we do a full day workshop where we get into the weeds on how to structure a renewable energy partnership and all the fun tax rules that come into play, et cetera, et cetera. And if you're going to the event and you're not sure yet if you want to do the Wednesday session, I'm telling you, most people who go to that will tell you it's one of the best, more value added portions of the overall conference. So I highly recommend it.
And I would amplify that by saying that even if you're experienced and if you think, well, maybe I'll go there and get a refresher, I guarantee that there will be some points made during the course of that session that you'll say either A, I didn't know that, or B, I had forgotten that in the most recent forecast or something else that I did. I could have used this idea to generate more investor equity. I mean, it's,
Mike, I'm a presenter and I say that. Okay,
exactly.
just with my co-panelists. I'll be doing a panel with Jim Duffy or Forrest Milder, and they'll say something that's new and hot or innovative, or maybe it's even just a reminder. And I just think, oh man, I'm so glad I'm here with these guys. So it's definitely value added. Highly recommend it.
The fourth topic outlined in the intro to this podcast has to do with the timing of capital contributions. This isn't a lengthy topic, but if you could just share with the audience what investors expect with respect to the timing of capital contributions, which, surprise, surprise, isn't nearly as quick as developers would like.
I think a lot of new developers are hoping that when they find a tax equity investor, that tax equity investor is going to be willing to contribute most or a substantial portion of their equity early on in the construction cycle. The developer is hoping that the investor equity that is going to be used to help finance and pay for a significant portion of construction costs. That's very rare. Although you might be able to find it, it's certainly not the norm. More often, what you're apt to find is the tax equity investor will contribute some amount of capital during construction, but it's usually not a meaningful amount early on. As a matter of fact, it's almost always more than half of their equity, sometimes even closer to 75% of their equity, gets contributed after the facility is placed in service. So if you're thinking you're going to use investor equity, tax equity, investor equity to finance construction, I wouldn't assume that. I'd assume you probably need to find some other form of construction financing.
Very good point. And I'll emphasize that point because we see it in other tax credits that we work with. And I always like to remind developers that in some ways, the tax credit equity that you're receiving is the most expensive source of financing that you have. Obviously, the yield to investors on a after-tax basis is higher than the yield on the debt. By definition, that's the case because it's the riskier capital. So to the extent that developers can push off those capital contributions, the project itself on a net present value basis is optimized. That's something that we see in other areas, a lot of more experienced developers focusing a lot on ways in which they can delay the capital contribution from the investor such that they can, on a present value basis, get a greater net equity contribution. Anything else you want to say about investor equity timing?
No, I think we covered it.
Great. So the fifth topic and last topic for this session, looking forward to having you back in May to walk through the other five, has to do with the co-mingling of business operations. And something that we're seeing a lot more of are data centers and renewables, but there are other examples. And if I'm a renewable energy developer who also is developing a data center to get all together, what are the chances I'm going to find an investor that will invest in the singular business of both the data center and the renewable energy benefits?
Yeah, definitely a lot harder to find that investor. Tax equity investors, they want to underwrite the issues that they're comfortable with and that they are familiar with. And that's a renewable energy asset. if you're asking them to invest into a partnership that owns both renewable energy assets plus non-renewable energy assets, like a data center, for example, now that investor has to become an expert on data centers and what are the risks with the data center business and how the data center operates. Some developers, again, these are newer developers, they're coming to me and saying, I've got a deal that's even better for the investor because not only does it offer tax credits and tax depreciation benefits, but boy, this data center business is going to generate all this great cash flow. And so the investor's going to love it. It's an even better deal. It's not just a solar facility, it's solar plus other stuff. The reality is that other stuff actually makes it harder. The investor has approval to do certain things, and the thing that they've got approval to do is a renewable energy asset. So what you're better off doing there is, in my opinion, what I see working more efficiently is you'd have the data center assets in a special purpose entity LLC, for example, and then you'd have the renewable energy assets in a separate LLC. And the idea there is the LLC that owns the renewable energy asset would enter into a power purchase agreement with the LLC that owns the data center assets, and the data center LLC would agree to purchase the power generated from the renewable energy partnership. That is an arrangement that a tax equity investor could better relate to and understand and probably get it through their underwriting criteria a lot faster than if the investor had to also underwrite all those data center assets. There are other examples where we're seeing developers try to commingle different types of business assets. I mentioned the data center one just because it's such a hot topic, right? With data center being built out there. So there it is. But we've seen other examples as well. But long story short, you kind of want to isolate the renewable energy assets from non-renewable energy assets.
We spent a lot of time in the course of the podcast referencing new renewable energy developers. And it has me start wondering, in your experience, when you're thinking of categories of new developers, I think of the market as solar and wind that are fastly approaching the July 4th deadline and other technologies. If you were to think of the new developer clients that are coming to the firm, roughly what portion are doing solar and wind for the first time versus embracing some of the other technologies that are getting more and more attention, and post July 4th, they'll get even more attention? What would you say the rough breakout is?
Yeah, definitely. We're not seeing so many new developers trying to do wind and solar for the first time.
Right.
Okay. And we're not really seeing wind and solar developers branching out quite yet on these these other technologies that we haven't seen as much of. So what we're really seeing when we talk about these newer developers, we're talking about developers that are new to renewable energy, new to project finance, and they're bringing these technologies where the technologies themselves may not be new, but the technologies are maybe less familiar to the tax equity finance space.
Thank you for that. And that part parcel with the new tech neutral environment that we're in. So let's bring this to a close. Any last minute comments you wanted to make on what we've covered so far?
It's been fun meeting these new developers. It reminds me to when I first started working in renewable energy and the solar industry was first getting going. You're meeting all these new contacts and making these new relationships. So it's been fun meeting these new companies and getting to know them.
No, it's also been good as we're expanding our own expertise across all these new technologies. The fact that we do such a volume of work. There's someone at Novogradac who has worked on transactions with that technology. And that's something that not everyone can say. And you definitely want to be working with a service provider that has experience with that particular type of technology. So they're not learning on your dime, if you will, as well as they can share what investor expectations are and the like with that type of technology. So thank you, Tony. These are important topics. Hopefully our audience found the first 5 that you shared useful. I look forward to you being back in May for the next 5, knowing that FIAC and PWA will also be on the topic. Now, before we jump to the weekly shout outs, which I always try to give you credit for, you created the concept of our weekly shout outs. So thank you for that, which we'll do in the off mic section. Let me take a moment to encourage our audience to subscribe to Tax Credit Tuesday. Also encourage you to take a moment to like the episode. If you like the episode and even if you comment, it helps raise our visibility. Please do also share episodes of Tax Credit Tuesday with your colleagues. That's a great way to get a refresher as well as expand your tax incentive horizons. And if you have any questions that you'd like to hear addressed on an upcoming episode, please send an email to contact@novaco.com. And as we've mentioned in the course of the podcast, we do have our Spring Renewable Energy Conference in San Diego, May 14th to 15th, with a day, May 13th, where we have additional sessions, as Tony mentioned earlier. I encourage you to join us for those as well. Tony and I will be there. If you do attend, please make a point to come up and say hi to Tony and me. Now we've reached our off mic section, and we use this space to give a shout out to others working in the tax credit and tax incentive communities. So Tony, who was your shout out this week?
Okay. My shout out this week is a long overdue shout out to my colleague, Nick Ives. Nick is a principal here at Novogradac. He works in the Andover office with me. We've been working together for a long time. Nick is great when it comes to cost segregation studies. He works on a lot of them. And he loves working on, if there's a technology that he hasn't seen before, he is the first to raise his hand, loves to meet those clients, loves to learn new things, get exposed to newer technologies, that kind of thing. So he's got an inquisitive mind. He's great. And so he loves these cost segs. So I'd like to give him a shout out for his role helping with cost segregation studies, in addition to other services. He's on the audit side. He's on the tax side. He helps with financial modeling. Great resource. So long overdue shout out to Nick.
Great. I echo that shout out. He's just an example of some of the great employees and partners that we have here at Novogradac, and I appreciate everything that Nick has done to date and keeps providing the service. And he's going to be racing through that July 4th deadline and beyond.
And he'll be in San Diego as well.
Great.
So
thank you for pointing that out. So Tony, thank you for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novaco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novaco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.